almost 23 years ago.
Yeah, wow.
So,
yeah.
Pretty
That's
fabulous.
Yeah, I love this little slide because we are all in this together. Marshall Reddick is here for you guys. This is a great QR code. If you're looking at the fund, you want to just hop on the website and take a look at more what we offer. Feel free to scan this. We'll also share this later on in the slideshow. But we are here for you guys no matter what questions you have about the fund. I think transparency is so paramount to how the fund operates, and something that, Pat, I know you instill in everybody that works in the fund and under you. Really impressive stuff.
But I also think that, whether it's fund or not, if you just want to talk real estate, you know, there's a lot of folks that work for Marshall Reddick in all different professions and avenues. And so again, Marshall Reddick's here for you, whatever it may be, certainly if it's the fund related as our topic this evening, but otherwise as well.
Awesome. Patrick Prunty?
Yeah, thanks everybody. I'm so happy to be here. As I mentioned, I would love feedback. I pour into this fund and into our private lending department and into this presentation. I take it very seriously. I'm a very, very detail-oriented person, so I'll try not to get too into the weeds tonight. But nonetheless, there does need to be some element of that detail. But again, I'd love feedback from you all that are listening, especially those have been investors in this fund since inception back in 2020, and that are also investors in our private lending department. So again, please feel free to provide that feedback. If there's things that I can bring to the table, if there's other metrics you'd like to see, would love to hear. Otherwise, always my pleasure to be with you. And Chris, thanks for hosting with me tonight.
And I know, Pat, you're a very busy guy, right? So that's why you've got a great staff, especially Kaylee, the fund accountant, just making sure everything is operating perfectly in the back end. And if you have questions, she's an amazing person to speak with, or go directly to Investor Relations, mrmf@marshallreddick.com. Tons of visibility on this. All the staff there can see all of your questions. So if you have any questions about the fund, this is the email to go to. And we'll be able to take care of you.
Yeah, this is a group email, multiple eyes on this. This is the absolute best and fastest way to get information, whether that's getting in, investing for the first time, or additional investments. It's also the best place to go if you have questions about redemption or withdrawing your capital, questions about tax forms, changing address, anything that's investor relations related. This is going to be the absolute fastest way to get an answer. So we're going to dive into it, and quick updates as of the start of the fourth quarter, which is also the end of the third quarter. Here we are in this third quarter. I can't believe how fast the year's gone by. We'll be into 2026 before we know it. And at the end of the day, folks, things are working extremely well. Very satisfied with the results and the performance of this fund, and I'm always excited to be able to share those details with you.
Yeah, well, I was just going to say, there's some high-level information here that is just really impressive to see. 341 capital partners. Now, I know there's a lot of employees that are a part of that. What percentage makes up of the Marshall Reddick employees?
Sure, yeah. Our staff represents roughly 10%. It has since day one, and that's in terms of number of investors in the count, but also in terms of investment capital. So with almost 78 million total, that includes just about 8 million in capital from folks like you and me. And that's fantastic. At last count, I think we had 34 Marshall Reddick staff members who have invested in the fund and are taking advantage of those returns as well.
I think that's so cool.
Again, as I mentioned, we launched back in 2020, and we're coming up on our 6th anniversary. Everyone's always looking to understand kind of what that return is. So our average annual return, 8.51%. We're going to dive into a little bit and give you some more detail about that as well. Portfolio continues to expand, 259 assets in that portfolio as of October 1st. Obviously, the number jumps around as we fund new loans. It goes up as loans previously funded pay off. That number goes down. One of the best metrics and helps me sleep extremely well at night is loan to value. When evaluating risk in lending money, it's understanding, what is the value of the asset that you're holding as collateral versus how much you've lent against it. And so our metric was always to stay under 65% from an aggregate perspective. Certainly there are some loans that have a lower loan to value, and there are some that have a higher loan to value. But when you roll it all up, we're under 65 and right there at that 62.7.
And I would say for me, I mean, I look at that 80% of collateral is in single family residential, right? I mean, the liquidity of that aspect is something that really drew me to the fund. I understand single family a lot better than I do.
Okay, so just to wrap up, just kind of the quick updates there. Something I'm really proud of as well. We love single family homes. 80% of the collateral that we're lending against, our loans that we're lending out, is that single family home. So very easy to value, very easy to sell if we find ourselves in some type of problematic situation. It's just a conservative asset to lend against, and let's face it, everybody needs a place to live.
That's right. One thing I see here is 80% of loans mature in less than 12 months. Why is that important for capital partners to see that information?
Sure. Well, we're hyper-focused on the short term, and that helps us with a couple of reasons. We can obviously reprice the interest rates, in a volatile interest rate market, which we found ourselves coming out of in 2022 and on into 2023. Hopefully that's going to taper off now, but who knows what interest rate holds for us. But we're also turning the capital over, right? So every time we get paid back on a loan, we're able to redeploy it. And as a part of redeploying, we're earning loan fees in addition to interest. We strive to charge a little bit under market, so whether that's 1.5 points or 2 points for every loan that we push out. And we're also turning over the entire portfolio literally every 8 to 12 months, and the money's just recycling through third-party escrow accounts and title insurance and all of that. So really overall, super pleased with how the fund is operating, and I think that staying laser focused on those short-term loans with the maturities of less than 12 months is key to our success.
Makes sense.
Okay, so fun fact from Q3, everybody. I put this in the memo that we issued last Friday. I hope everyone took a look and read that, but we reached our 1,000th loan origination during the quarter, ending with 1,011. And that's $276,500,000 in capital that we've lent in just a few couple of years. So we're thrilled about this milestone. Next stop, 5,000 loans. And this is just with our fund, right? This is not our operating history. Certainly we've done way more loans than that, but in this short period of time. And I also like to share, as you can see here, only 5 of those 1,011 have completed, ended, loan paid off, or property sold, or whatever the situation was in an event of default. Certainly that doesn't mean that people miss payments periodically. It depends on your definition of default, I suppose, but we're talking about actually completing the loan, which is an extremely low default rate, much lower than our overall private lending department. And I think that that's an attestament to the cherry picking that we do in terms of what loans from our overall pipeline go into this fund. And just because we have a default doesn't necessarily mean that we're losing money. Right. Some of those 5, we've gotten all the principal back plus some earnings. Might have been a short sale where we're just giving up a little bit of the earnings there in the back end. Sometimes we have to go to foreclosure sale. We end up owning the asset, and as happened in this last quarter, you're going to see that we actually had a gain on sale after foreclosure.
Yeah.
So,
it's not the ideal thing, but it doesn't necessarily mean a terrible outcome when that occurs.
And when you're lending money, you have to understand that there's going to be defaults.
And
things happen,
risk, right?
Happen to people, and at the end of the day, we just bake that into our model and into our returns and how we approach things from a risk perspective.
Well, if you haven't already joined us, you absolutely should join us for the Marshall Reddick Mortgage Fund. It's a safe and passive, consistent cash flow. We're going to put together a lot of slides here that show where we can direct you to the data, and you guys can inquire with me directly, of course, if you're interested in making a contribution.
Folks, there's a really good argument that some element of your portfolio should be in some fixed income, well-diversified fund like ours with alternative investments. And alternative is great. It just means non-correlated to the overall stock market or traditional type investments, whether those are CDs, money market accounts, again, stocks, bonds, mutual funds, that type of thing. So lending against real estate, good loan to value. I think everyone needs to take a look at this if you haven't already. A couple of metrics I always like to share. These just go to show our methodical approach. So we're looking at net total investor capital by quarter. So again, we just finished our 23rd operating quarter, and we're just taking a very slow, methodical march up to our goal of $100 million in investor capital. And we want to do that because we need to avoid cash drag. We certainly could go out and raise capital faster, but there's no point in doing that if we can't keep the capital working and keep it working in good, safe loans with collateral assets that we wouldn't mind owning, as well as with good, solid loan to values. Same type of metric here. We're just talking about total number of investors. And when I say net, understand that we have a fantastic liquidity policy. So if you need to exit the fund, you absolutely can do that after only your short 12-month minimum hold. And again, so this represents quarter over quarter the net number, including folks that have been in the fund for their 12 months or longer and then have exited or withdrawn their capital. So again, just that slow, methodical march. One of the things I wanted to tie in about that with the continued uptick in capital and number of investors is that we've been able to maintain an extremely steady, by design, return on investment. So this graph is just going to show here by quarter, all 23 of them, what our fund earnings. This is before profit split. So this is, includes the preferred return and 100% of all earnings that are being distributed. When it gets down to the fund level, obviously there's a split based on your capital account. But the point here, folks, is that we've been able to maintain consistency, and we haven't seen a drop in our earnings as we've added more capital. To me, that absolutely means that we're able to keep the capital working, we're able to avoid cash drag, and we're able to keep it in good, solid performing loans that are paying off within their allotted period of time, and again, performing exactly as we intended it and designed it to do so.
Yeah, and one question I sometimes get is, well, aren't there loans out there from private money borrowers that are 14, 16, 17% interest, right? And you might be lending to people that may not be the most experienced of borrowers. So this consistency probably reflects the type of borrowers that you're lending to.
Yeah, we're a small fund, and I think overall one of the best parts about our private lending department that comes out in our fund is our repeat borrower business. And we like to lend to the same folks over and over, and we support a lot of, if you want to call them mom and pop real estate brokerages, property management companies. These are folks that are located in whatever geographic market around the United States that they're from, that they grew up in, that they're professionals in, and they just know those markets. So we like to lend to those types of folks. So these are definitely investors, and could be anything from wholesale, transactional funding, ground up new construction. We do a lot of fix and flip. And so absolutely, I think that we have refrained from entering that subprime market, from taking advantage of those folks maybe that are willing to pay that 18% or higher interest rate because they don't have any better options.
Took a course online or something.
We'd much rather lend to someone with the experience that knows what the private market will bear. It's very competitive. And so by design, we keep our rates, terms, fees, all of that very competitive to attract and retain that quality client. So just some high-level numbers here as we kind of work into the details. We ended the quarter with fund earnings, again, fund level, net of expenses, 2.455%, annualizing at 9.82. This is our second quarter where we have had above $1 million preferred return. I think that's a fabulous number. I don't expect that to go below $1 million, and pretty soon we'll be on to 1.5 and 2 and so on as the fund continues to grow. But then you add in the additional profits generated on top of the preferred return, which is the hurdle that we have to reach before there's any split with management. And certainly we're in business here to make money with this fund. And so when we get down beyond that $1,065,000 into that nearly $700,000 in profit to split, that's where we come in and we participate in that profit share. Just rounding up to the $1.7 million number that you see here, which is reflected on our profit and loss statement. And that's something that we publish every single quarter. It's available on the website for download. So please, we're going to be showing it here as we progress through this. But if it's small or you're unable to see it when we get to that P&L, just know that in our desire to maintain transparency, that it's always there for you to see.
Yeah, there's a lot of new folks potentially. I know there's a lot of, we see some names here. A lot of our clients are already capital partners with us, but there's definitely some new folks on the call. What is the Marshall Reddick Mortgage Fund? I mean, we've kind of talked about broad level, but what is the Marshall Reddick Mortgage Fund investing?
Yeah, totally.
Let's dig into that. Like, who are we lending money to, and why those folks?
You got to understand first what our private lending department does, and very simply, we do one thing, we do it extremely well. We're not lending to owner occupants. It's strictly non-owner occupied. It's strictly short-term lending. Our standard loan term is 12 months, but we're also dabbling in a little bit of transactional funding with 3-month and 6-month loan terms, but hyper-focused on that short term that allows us, again, to reprice the interest rate, to charge more fees when we get to maturity, and to turn the capital at least once every 12 months. It's definitely got to be first lien position. In that case, the worst case scenario in the event of catastrophe is that we end up owning the asset. Mm-hmm. Every loan that we make goes through escrow, has title insurance, so we are assured of that first lien position. We do not dabble in any type of junior or mezzanine funding or anything else where there's potential for anything other than owning the asset at the end of the day.
Got it.
It's got to be a reasonable loan to value, right? Good is subjective, but again, if we're lending against a quality collateral asset that's going to maintain its value, especially on the residential side, especially in a single family home situation, if we've got a good loan to value, our risk is very, very low. And this is designed for the real estate investor. So the person who is out in the market, maybe doing direct mail that, it's so interesting what real estate people do. I have a guy in Oklahoma and he's made friends with all the probate attorneys in town. Yep. And guess what happens when the probate attorney gets a call and a death in the family? They call my guy Tyler and he's right there to write him a check, the kids that are inheriting the property. So real estate investors, extremely talented and smart. Yeah. Absolutely. And then again, it's always secured against residential assets. We're not doing any commercial, so there's going to be no industrial, no medical, no office, no mixed use, anything like that. We will lend, obviously, against other residential assets, including small multifamily properties. Okay. That's a little bit of a niche that we fill, so units 5 and greater. And but we're really not going to be getting into anything above 20 to 25 units. That would be too large of an asset for the size of our fund today. So perhaps as we continue to grow, we might be able to go above that.
When you say too large of an asset, does that just mean it might take too great of a proportion of the capital that's in the fund?
That's absolutely correct. We can't have any metric that over levers the fund, right? So it can't be any one loan or any one borrower or any one investor or any one geographic market. We have to maintain that diversity. And, we certainly wouldn't want to make a $10 million loan with an $80 million fund. Right. Yeah. That one goes bad, it could drastically affect things. And so we try to stay in proportion.
Makes sense.
So then diving into the fund and how that segues from what our private lending department does, understand that we're just simply a private investment fund, currently organized as a Reg D under 506C. They're on the roadmap we've been talking about this for some time, is transitioning into a real estate investment trust or REIT. That is absolutely going to happen in 2026. I'm very excited about that. There'll be some major tax benefits and some other benefits for the overall capital partner pool. But this fund operates in perpetuity and it always will. There is no end to the capital raise. There is no end to the operation of the fund. It's like a mutual fund. You can get in, you can add more capital, you can get out partially, you can get out in full, and we have just some very loose restrictions on your ability to get in and out. Very simply structured with a waterfall that includes just a preferred return and a profit share. There are no load fees. There's no investment fees. If you put in $100,000, you get credit.
$100,000 working for you.
Absolutely, okay. Right. Everything that we earn is an expense to the fund, and so when we talk about net of expenses in our returns, that's all included. Okay, and so the asset management fee that we earn, not a profit center, that is just simply covers our portion of Marshall Reddick, who's the manager of Marshall Reddick Mortgage Fund. Those operating expenses, my salary, the team's salary, our share of the office rent and utilities, and so on and so forth, to help manage and produce the operation of the fund. So at the end of the day, at the end of every quarter, we look to net income or net profit, whatever you'd like to call it, and we distribute 100% of that and just start back at ground zero every quarter and do it all again the next quarter. Strictly, again, funding loans underwritten internally by Marshall Reddick coming from our private lending program. We're not buying loans from anybody else, at least not today. We're not underwriting, funding loans that have been underwritten by anybody else, potentially not with the same like metrics and quality standards that we would expect. And I think that this comes out in the success that we've had since inception. So we talked about the management fee there. I'm just going to give you a brief look here at our profit and loss statement. Again, this is published online if it's not big enough for you to see here, but I just like to point right to that management fee expense there. Management fee is 2% of net assets under management paid monthly. And so the 3 months in the quarter based on our net assets under management reference that roughly $350,000. So it's right there as an expense, and that is not the profit split. That is separate, but again, this is just since the fund has no employees and no overhead expenses, those are all borne by Marshall Reddick, the entity that is the manager of the fund. It's important to understand that management fee. And again, this is standard for all types of funds, whether it's a debt fund or a apartment syndication or anything of that nature. And again, just so that we're all on the same page. So the historical performance section of our fund site, the site on the marshallreddick.com website that we've set up specifically for this fund, I always publish that quarterly investor letter that I released last Friday, and the financials are always there. So when you go right to our homepage, as you can see here, you hover over invest and you click investment fund. This is the site that you'll get to. And again, you just have to get to the historical performance section to find this link to where you can always find that profit and loss and that balance sheet from the prior quarter.
I'd say a lot of my clients is the very first thing that I direct them to when they have curiosity about the fund, just because of the level of transparency. I mean, I think you're going to show this, the map, the diversification of the fund. You can literally click in the map on each state, look at each loan, and see how it's performing. I don't know how many people do that.
I don't know. I haven't found a lot of other funds that give that kind of.
Think so.
But we want to we want to do one thing, and there's many investment options that are out there, and we want to do one thing and do it really well, and that means that we want to make good, solid loans that produce good, solid returns, and we want to be good stewards of your capital. And certainly you can go elsewhere potentially for a higher return, but you have to factor in the risks that you might be taking to chase that a bit of a higher return.
Yeah, for those folks that are new here on the call, it's a $25,000 minimum investment, so very low entry into the fund. For those that are just wanting to try it out, you pop 25 grand in if you're an accredited investor, see how the fund performs. I mean, that's what I did with my initial capital that I invested in the fund. I wanted to kind of test it out, right? See how things worked, where I felt comfortable, and then gradually increase.
Dip your toe?
Yeah, dip my toe. I wanted to make sure this was a working and steady investment fund, and it absolutely has been. I've been invested and continue obviously to add capital. So 12-month minimum hold, but after that you kind of phrase it as like a month-to-month lease, I guess. Like you can get out.
You don't have like a perpetual 12-month term that you sign up for. You just have that initially.
Every 12 months you have the initial, and then you give you notice and you can redeem capital, and you can invest additional capital at any point in time. Right.
Which I find that a lot of people do, right? Like you said, they want to get started, whatever small is in their mind. That might be 25, that might be 50, that might be 100. But you can always add more. So I am a conservative investor by nature. It's how I was raised. Certainly seeing what happened in 2008 and 9, my career here at Marshall Reddick shaped the way I look at things as a money manager, my investment criteria. And so you can, again, always add more later.
Yeah, definitely. The 6% preferred return, I mean, I really like that aspect of it because I know I'm getting that 6% before Marshall Reddick gets paid out in terms of the profit split, right? And then everything on top is the profit split. The 50, 60, 70% profit share, you're going to obviously dive into that, but it's based off of your capital commitment and how much money you have invested in the fund. You can increase your profit split with additional capital. Now, automatically reinvesting, so you can just leave your money in there and compound, or you can take it in just a cash dividend. So this is, as you phrased it, a very passive cash flow vehicle. A lot of people are using this as like a kind of a retirement pension sort of deal. Yeah. They're just taking their quarterly distributions. And I think a lot of people you've worked with, you invest in their self-directed retirement accounts. I don't know if you want to share kind of the values of that and why.
Yeah, I think we have north of 100 of our 341 capital partners as of Q1 or October 1st, if you want to call it, that are using some type of self-directed retirement account. Could be a solo 401k, could be an IRA trust or an IRA LLC. That there is just no better place than a debt fund, in my opinion, with risk-adjusted returns. Again, very, very low risk in this type of fund when you have good loan to value and good collateral assets. And the idea, though, is that it's very hard to manage your own money amidst family and work and wanting to take a vacation periodically and things like that. The last thing you need to do is worry about cash drag in your retirement account. Yes. And so the fact that in our fund you can reinvest your quarterly earnings, I think is a fabulous place to invest and to continue to grow that retirement account.
Yeah. Now, you must be an accredited investor, but that's not a term that you and I or Marshall Reddick made up, right? It's an SEC term, federal term, but that's very easy to get accomplished through your CPA or a financial advisor, or there's even third-party services that can get you accredited. Obviously, you have to qualify based off of income or net worth, correct?
Yeah. Accreditation it's not a big deal. It's very standard. It's a government term, and Chris will help you get through that without issue.
Yeah, absolutely. Now, topics of discussion. I mean, we're really just going to give you guys the highlights here and dive a little bit deeper into the performance of the fund. So let's get into it.
Yeah, and we had a question from the crowd. I'll address that now. And it talked about, with all of this jargon or jockeying or talking about interest rate decreases, I certainly think that would help overall economics. I don't know if I believe that we're actually going to get any meaningful movement in the rates, but how does that pertain to us? How does that affect us? And the answer to that is absolutely zero, right? We set our own rates and terms, and we base that on what the market will bear. It has absolutely zero to do with what the government rates are.
Got it.
So the government rates, when they were back at 2.75% in late 2020 and early 2021, we were still lending at 9, 10, 11, and 12%. That is just the going market for real estate investors in the private market, right? Speed is what they're after, and sometimes the asset doesn't qualify for that conventional financing. I mean, we won't get into all the nitty gritty about people why they borrow private or hard money, but just understand that no matter what the government rate does, it is going to have zero effect on our ability to continue to deploy capital as we have.
Got it. So it's not tied to the 10-year treasury or the federal funds rate or anything. It's just based off of, hey, we can attract great borrowers with this interest rate and still keep a profitable fund.
That's right. Okay. Right. We're just lending 100% equity. We're completely unlevered. So let's talk a little bit about the fund purpose, right? And very simply is always to provide the Marshall Reddick client with a safe, consistent stream of income. This is an income and dividend fund. That's what it is. It will not lose money. It will not produce 20% returns. It will be right there in the middle. The goal is and always has been 8% per annum in the form of a 2% quarterly coupon. And just to never, ever, ever miss
deviate
a distribution, right? Just every single quarter, you just know you're getting that check, whether you're actually taking it in cash or you're just adding it onto your capital account and earning on your earnings.
Yeah, I think the folks that I talk to, especially right now, I mean, probably there's different market cycles, right, that you've seen for why people invest in the Marshall Reddick Mortgage Fund. But from what I hear from the folks that I'm speaking of to, a lot of it is just kind of the economic uncertainty of where like the U.S. stock market is, and we were at an all-time high, and a lot of stocks or just a handful of companies are driving really the growth of the market right now, and it's a little maybe uneasy for some folks and a little skeptical. So having something where there's a lot of certainty and just historical performance
and security, right? I mean, if you believe in U.S. real estate, you believe in this fund.
You can touch the dirt as opposed to, well, we're looking at what NVIDIA and how many chips they can produce and AI advancements, and it's a little uncertain, I think, is how people feel. But
absolutely. Again, so keeping with the earnings distribution and always pointing back to our site that we've set up specifically for the mortgage fund, you can go find that historical section again, and we just post our quarterly earnings quarter over quarter, along with the amount of capital, the number of investors, the number of loans in the portfolio. So just make sure that you spend some time there. It's really a helpful spot. getting into the strategy, again, very simple. We want to regularly, those recurring borrowers, lend capital to known investors, people that we've done business with. Some of my folks, like I got guys in Memphis, Tennessee, I've been doing business with them for all 22 years, 23 years that I have been a team member of the Marshall Reddick business. And it just brings an element of just safety and security. I just love when they call and they're looking for a new deal, because I just know that they're not going to miss a beat. They know how to buy it right. They know how to do the fix. They know how to do the disposition. Their numbers are right on. That comes from experience. And to just doing this at favorable loan terms, as sort of you talked about, staying competitive to retain those relationships, and just supporting entrepreneurial real estate businesses all around the country. It's got to be first lien, as I mentioned, favorable loan to value, and it's always got to have that security against residential assets that we'd be happy to own.
Yeah.
Right. And if, again, just kind of example here, if we're making an 80% loan to value loan against a nice single family home, in the event of default, we're in essence buying that asset at 80% of what our borrower bought it at, right? It's their 20% was their down payment that they potentially have at risk in the event they were to default on that loan. So again, I look at every single loan, and so one of the decisioning factors that our underwriting team always asks themselves is like, are we good owning that asset? And if we are, then we feel great, along with, of course, all the other underwriting metrics about decisioning and saying yes to that loan.
Yeah, go ahead. I know you're eager to hit that button right
now. Yeah.
But what does the fund invest in, and why? What's the why behind this?
No, absolutely. I think first we need to talk about what does it invest in, and again, we're just beating this over the head, but I just need everybody to understand that it's secured debt, right? That people want to know is like, what's my security in here? Well, it's the U.S. residential real estate market.
It's not a promise from the government to pay you or something.
That's right. I know a lot of people think that your money market or your CD and that your FDIC insurance is safer than this, and potentially it is, as long as you trust the government. And obviously unique, interesting times right now with the government shutdown, and who knows how long that's going to go, which is why, again, I'm a born and raised real estate investor, and I firmly believe in the residential U.S. market, and I have been through the ups and the downs and lots of different scenarios. So we just got to stay the course. But as far as why, really, here we go. It's safety, low risk, and it's cash flow. There is no appreciation in this fund. There's no share price, right? It's a capital accounts based accounting, right? You are taking your earnings, or you're leaving them in to be earned on. But that's why you're here. Again, an income and a dividend fund. It's very consistent, 23 consecutive quarters. We expect to go the next 23 and then the next 23 on top of that, and just never miss a quarterly distribution. It's predictable, right? We have time. We have 12-month loan terms. We understand what the market is doing on a regular basis, and we can adjust interest rates and loan to values. We can ask for more down if we need to. We can write on adjustable rate loans in a very volatile interest rate market if we needed to. Again, risk adjusted high returns. I don't know if there is a better place to get an 8, 9, 10% return on your money with this type of risk. Again, I'm talking about under 65% loan to value. And again, just those repeat borrowers just make everybody feel good, because there's a track record. There's a level of trust. They know that they need to perform on these loans, even if they're going to lose money. The borrower's going to lose money, right? They're going to step up and pay off that loan because they want to maintain this relationship and be able to borrow capital in the future for all of those other deals where they're making money.
Yeah, they got to have skin in the game too, right?
That's exactly right. Yeah, so a little bit about portfolio holdings. Sticking with our first lien and ownable residential assets, as you mentioned before.
Yeah, this is where I really geeked out the first time I jumped on the fund website, and I just started clicking in and looking at the loans, looking how much data that was available. You absolutely should jump on the website and look at this. Obviously, there's a lot of diversification amongst location, but there's obviously a lot of diversification in how many loans you have in each location. Do you strategically plan that, or how is this sort of guided from your guys' team?
Yeah, well, we Marshall Reddick has a number of offices, heavy in Texas, offices, of course, in Tennessee and in Florida. So you see an aggregation or a higher number there in those particular states, which are also particular favorites of my own. I own rental property in all of those states. But then otherwise, we're looking at a lot of Midwest, a lot of South. And in some cases here, these are hotbeds for real estate investors.
Right.
But there are also locations where I know that mom and pop real estate brokerage, that person I've done business with for a very long time. And so we kind of go a lot of times where that trusted borrower is. So you see heavy presence in Indiana, heavy presence in Ohio. Those are really solid markets, not only from the who is there borrowing money from us, but also from an economic standpoint.
Definitely.
Pretty diverse. You're not going to get the wide fluctuations like you would in a California or a Nevada or a Florida.
You don't have any loans in Illinois. I'm a Chicago guy. But definitely the Midwest market, I can attest, definitely is not a balloony boom and bust type of market. Right?
The Illinois has some adverse foreclosure laws. That's something that we look at. That's why we stay out of the eastern seaboard. There's no New York, no Connecticut,
We got
no
the California
Massachusetts.
laws, but not the California weather in Chicago.
Yeah, that's true. That's true. So again, this is available on our fund site that we've set up specifically that anyone can get to. You don't need any type of special credentials. Return on investment, obviously top of mind for most folks looking at investing or continuing to stay in with us in this fund for the long term. So again, on the website, we produce what the since inception is, as well as the 1, 3, and 5 year, and understand that 8.51% since inception is based on our lowest tier, right? Our investors in our higher tiers, which I'll describe here in a second, they earn a higher split of the profits after the preferred return, so their returns are higher. We just obviously advertise our lowest tier return on the website, and this is a since inception with earnings reinvested. Okay, so important to understand. So if you were an investor from day one in this fund, like me, and you've been investing or reinvesting those earnings from day one, again going with a growth strategy as opposed to necessarily a cash flow strategy, you'd have been earning this 8.51%. Here are those profit tiers that we talked about. So under 500,000, you're earning the standard 50-50. Over 500,000 up to 3 million, you're getting an extra 10% of that profit split. The management team is taking the hit on that. That's not a penalty to any of the other investors.
Right.
We're not dipping into that to hurt anybody. It's just simply as you invest more capital, there's value there, and we're willing to take less profit split on those positions. And then, of course, our highest split for capital accounts over 3 million, you earn a 70% split of the profit.
Got it.
And it's someplace between 35 and 55 basis points in an increased return for each of these 10% increases.
Okay.
So like if we're talking about an 8.5% for our base tier, then you can expect someplace about 8.75 to 9 for that second tier, and then like an 8.25, or excuse me, a 9.25 to 9.5 for our 70% profit split folks. Okay, so I'll let you handle this. So why invest?
I mean, I think we've touched a little bit on this. I mean, if you've got idle cash, like you said, CDs, money just sitting away. I know I've been talking to my mom about this, right? About investing money that she's had just literally sitting aside, not doing anything. I mean, if you're looking for something that is secured by assets, that is low risk, that is consistent, I think the Marshall Reddick Mortgage Fund is a great place for it. I talk to a lot of folks with just underperforming real estate assets, in California even, right? And they're potentially looking at inheriting real estate, and they get a step up in basis. They don't need to do a 1031 exchange, but now they've got a lot of cash. It's actually, we had a capital partner, don't want to name him by name, but that's exactly what happened. He put some money after the sale into the Marshall Reddick Mortgage Fund, just for that safe, low risk cash flow. It's consistent, it's predictable. It's all of the things that you would want if you're looking for a just sit back mailbox money, right?
That's exactly what this is, mailbox money.
Real estate, the IRS frames real estate as passive income, but I own investment property, you own investment property.
It's not that passive.
How it's not that passive, right?
Yeah.
So, and it's backed by residential real estate, so I think you get best of both worlds there. For sure.
Yeah, and you mentioned 1031 exchange. Unfortunately, you cannot 1031 exchange into this fund, but it's a great place if you have some boot left over, and you're looking for a place to stick that. That's a great spot for it.
Yeah, and you don't want to have to force yourself into an awkward investment property, right? I know people that have like tied themselves up in knots with 1031 exchanges just to not have any boot. Sometimes
it's just better to pay a little bit of tax.
A little bit of tax. Exactly. How to invest. So you can book a consultation with me. You can do that directly. We're going to show my contact information again, of course. You can request access to the fund portal through me. We're going to share a lot of that great information on the website. And I can help you with the accreditation process. As we discussed, it's not too challenging. We can qualify you based off of income or net worth. And then there's just a DocuSign with a subscription agreement. We can do this all online, very simple stuff. Or even better yet, come into the office, right? We have clients that we invite to the office. Not all of our clients live locally, but if you do, we want you to come in and meet the team. Meet myself and Pat and the rest of the folks and sit down and ask us questions direct. That would be great. And we can sign it on paper or we can do it electronically.
Yeah, I have some old timers like my father, right? Yeah. He's like, I don't want to mess with that technology thing. I want to come in and see you and sign the paperwork right here. Yeah, absolutely.
That's okay too. And then obviously for deposits into the fund, wire transfers, easy. Right.
Yeah, I think that the fund portal has continued to expand its abilities, and that's really the safest way. I think there's a lot of wire fraud going on in the industry, so certainly if you prefer to wire, you can do that. Make sure we're verbally verifying with a trusted phone number. That's something that we do for every loan that we fund. But when it comes for you as an investor in depositing capital for the first time or on an ongoing basis, I recommend doing it through a capital call, and you can just connect a bank account through an integration with Plaid, right? Through the portal, and that's just the safest way to transfer money, just like you would with, say, Vanguard or Charles Schwab or any of those accounts that you're able to connect to your bank account.
That way you don't have to worry about wire instructions coming through that are via an email you don't really trust. Okay,
yeah, makes sense. Right. And then just start collecting.
Just start making your money.
Yeah,
easy peasy.
Yeah. All right, let's get into the weeds a little bit, folks, in terms of what those financials look like. Again, I'm a very detail-oriented person, so I hope I don't put you to sleep with that. But here we go in terms of origination data in Q3, 54 loans, and I also have Q2 here just as a perspective for the prior quarter. So same number of loans originated, but a little bit lower average loan amount, as you can see, and we deployed about, $4 million less capital. So that's not ideal, but there are many reasons for that, okay, and that's not something negative to look at, right? So it did, however, translate into a spike in cash. If you were to take a look at our balance sheet, we did have more cash on hand did we turn the quarter, but it's been a very feverish start to the fourth quarter, and we deployed that capital extremely fast. Every quarter is a little bit different. No two are the same, and you looked at the prior quarter, it was the complete flip-flop of that. Again, average loan amounts, that's by design, making sure we're not lending against too high or unique of collateral asset. And then some of my favorite metrics are the weighted average interest rate and the weighted average loan term, because certainly you can't say that a loan that's $50,000 or a loan that's $1 million at varying interest rates have the same weight as it pertains to the fund. So I'm going to compare origination and payoff data here, and you'll see what I mean by that. So again, we pushed out that $14.5 million at over 10% interest with a loan term weighted average of right on the nose at 12 months. I'd love for that to be below 12 months, but if we're close to that 12, we're in really good shape. In terms of payoffs, so this is incoming money. We had 68 loans pay off. It's hard to keep up with that number of payoffs, especially with incoming capital, but we were able to do it. But it was up a little bit there from Q2, and incoming payoff volumes, again, flip-flopped. So the prior quarter, we had a lot less in terms of volume coming in as compared to this quarter. Just the average interest rate, and then the same in terms of the average interest rate and the average loan term. So as that really dials up here, understand the comparison. So we are bringing in $18 million of loan payoff, okay, that was earning 10.18% average weighted rate that had been out for 13 or was written on a 13-month average loan term, because sometimes we do loans of longer than 12 months. And then we're pushing capital back out the door, 14.5 million at a higher weighted average interest rate. I mean, it's a nominal number there, but anytime you're pushing out dollars that we're earning less, that's helping us drive our yield at a lower average loan term. So again, they might not always continue to go down, right, or up on the interest rate and down on the loan term. But if we're bringing in money that was at a lower interest rate in a longer term and we're deploying it at a higher interest rate and a lower loan term, that's the metric that we're looking for.
That's ideal.
That's the special sauce.
You get to recycle the capital and earn more
for a higher return.
And higher return. Okay.
That's right. So summarization of that P&L that we looked at, revenue about 2.3 million compared to what we had in Q2. Expenses jumped up a little bit there. Some of that has to do with our replenishing of our loss reserve, including putting in the entire amount that we gained on the sale of the REO that affected the loss reserve in Q2, which I spoke about in the past investor call, and then just getting down into that net income at 1.734. That 1.734 again represents a 2.455% total fund earnings. So that percentage is based on the $77 million that we have. And you'll never be able to calculate that number, right? Because we start the quarter at a certain amount of capital and we end at a certain capital. And every day in between, all 92 days of Q3, had new investors coming in and other investors going back, and so it's a very complicated calculation that we have to undertake. But nonetheless, when you roll it all up, that's what it represents for the quarter. That's before profit split, annualizing it just under 10%. Okay, compare that to what we've done since inception. Again, this is our 23rd operating quarter, so now the 24th operating quarter we are in now in Q4. Our lowest had been that 2.42 or 968 in terms of an annualization in 23, and our highest was 3.15 per the quarter and 12.6 annualization in 2021. Things are going a little bonkers. They're coming out of you know what. But nonetheless, the idea in sharing this with you is just the extremely tight range of returns. And we're accomplishing that by sticking to exactly what we set up and how we designed this fund. Safe, good loan to value, quality residential assets, first lien possession. All right, so again, here's that P&L, and I like to break it down in terms of the same metrics that we just described there, the percentage. And then I like to get into, again, that 6% annualized return. That's 1.5% for the quarter. That represented that 1.6 of the total 1.7 that we had earned. That shows there on net income, right? So right on the P&L, we're distributing 100% of that net income at the end of the quarter. How does that break down by partner and their varying profit splits? Well, again, you're earning a little bit higher a percentage of that profit that's to be split after we hurdle that 1.5%. And then we just roll that up, preferred return plus your profit share to get to what your quarterly return was, and then just annualization is just multiplying by 4. Again, no 2 quarters are the same, and so annualization is just for perspective. But again, nonetheless, just right on the nose at what we projected and what was anticipated, and really pleased with the performance here.
Incredible results.
Getting onto the balance sheet, this is where we're going to point out again that loss reserve. So we had our largest contribution here since inception. A lot of that driven by that gain that we had. I'll go back to our P&L here. Up in the revenue section, there's that gain on the sale of REO. I'll talk about that here in a second. In essence, we foreclosed on a property and then resold it, and we sold it for more than the value of it at foreclosure. And so we had to write that down as income. But that did affect our and lowered our loss reserve in the prior quarter, so we socked it away, and so that's why we had that increase really in that loss reserve. And the loss reserve is there for all of our protection. This is a non-deductible expense, and this goes to offset future credit losses. Look, we have had few credit losses in the life of this fund, but they do happen. They will happen. They're part of lending. And this type of loss reserve and this expense situation that I'm describing, this is what audited funds have to do. And we're gearing up for that audit. This is what banks have to do. This is very normal in the industry. And so again, that loss reserve accumulates, and you can see it on the balance sheet here. So as of October 1st, that loss reserve represents $440,000 and change. And this, when we do have loans that end in default and there is a loss that we need to write down, they will lower that bucket. They will not affect the profit and loss statement in that quarter. Okay, so rounding it out there, that loss reserve at 440 represents about 0.5% of all capital. I think we're a little bit underfunded in our loss reserve, and so we're going to start seeing some higher aggregation of that loss reserve, just for everyone's protection, and as we prepare for that third-party audit. We've been talking to our CPA firm, big firm that's going to be undertaking that audit for us in 2026, and there's a lot of metrics and things that you have to do to prepare for that. One of those items is that loss reserve. They're going to be taking a deep dive on that and making sure that it aligns with the size of our fund. Okay, so as I mentioned last quarter, we encountered a few problematic loans. I'd like to share those details. So one I shared last quarter was that 17th Street in Cape Coral. This was an as-is sale. It was new construction. The borrower, a home builder, went belly up in the neighborhood, and we had no choice but to foreclose on the asset. And we ended up actually going through that foreclosure in Q2 and having to put that asset as an REO on our books. We shortly then, after Q2, disposed of it. We just listed it on the market, sold it. It sold actually very quickly, multiple offer situation, and we sold it for $56,000 more than the value at the foreclosure
It's nice having
sale.
Offices where our real estate offices where some of these loans are.
Yeah, and so again, that's one of the reasons our loss reserve was up there, that 167. We put all 56 on that gain back into that loss reserve. We did have another short sale that we went through. It was just time to cut this one loose here on 11th Street in Indianapolis. We sold it to a third party. We had nursed this loan to the finish line, advancing to complete the construction. So it was a completed sale sold to a third party. And this did have an effect on our loss reserve. So it did lower that loss reserve. We had aggregated for future credit losses, which we did experience in that third quarter. But again, the point here, folks, is that the loss reserve is functioning as intended. That's what it's there for. We sock away a little bit every quarter based on the size of our fund, based on the number of problematic loans or perhaps late payers that we have in the fund. And so it's there when those loans get to the point where you have to write them down from an accounting perspective.
Got it.
But nonetheless, our portfolio is super strong and continues to be so, right? 259 loans in the portfolio as we turned into the fourth quarter. We've talked about the loan to value. We've talked about the collateral. We've talked about the low the short loan terms, and we've talked about our core focus. You saw the map, right? So we're just going to stay the course, stay with the trusted borrowers that we know, even as we continue to expand. Then I do expect our average loan amount to increase, but I think that that's normal as AUM or assets under management continue to increase. So just to kind of round out that third quarter, super pleased with the performance and the results of the fund. We absolutely expect the same to continue. I know that there's some volatility in the market and people are looking at the stock market and all-time highs and government shutdown and this, that, and the other. But from my perspective, we're doing the absolute right thing. We're being great stewards of the money and putting it into great deals. And I think you're going to continue to see us just release that quarterly distribution that you've known and that you expect to see.
We love referrals, right? I mean, how many of the folks that have committed to the fund have come from friends and family members?
About 100%.
Yeah, just about everybody. We're not out there marketing on TikTok with the Marshall Reddick Mortgage Fund. So
we're not working through broker dealers or anything like that.
Right.
There's no need to do that, right? You talk to your neighbor and you're telling them how much fun you're having and what it's like to collect that check every quarter.
Absolutely. So we love referrals and are going to take great care of your family, friends, and colleagues. So a lot of you are in the fund. If you're having a great time, watching the kind of the chaos around you, and you're getting your quarterly return every single quarter, feel free to share that information with your friends and family. We'll take care of them. So what's ahead for the fund, Pat?
Yeah, same. I don't want to be boring, right? But we're just staying the course, right? No style shift here at Marshall Reddick. So we're going to continue to march to that 100 million goal that we had. We're going to continue to be distributing between 8 and 10% per annum based on your capital account and the size of it. We're going to continue to grow the team, right? We've been continuing to add really good folks. We've got some account executives coming on board. We've got a underwriting manager coming on board. We've got some really awesome hires, some good software folks as we continue to improve from that perspective and help efficiencies. And of course, the REIT installation and the audited financials. I'll be super excited. A ton of work, but I'll be super excited to share all those results with you when those become available.
Incredible. Well, if you're an existing capital partner looking to increase your position, we'd love to help you to do that, of course. You can email us right there at MRMF. This is the shared email, right, with all the transparency. So
the absolute fastest way
to get eyes on your inquiry, and we can help you out. Now, of course, you can also, if you're a new capital partner making an initial investment and you just have some questions and you want to connect one-on-one, feel free to call me. There's my cell phone right there. I'm not shy about just putting my cell phone out there to the world. That's my job. And scan that QR code. That'll lead us right to the website.
Yeah, it'll take us right to that fund page, and literally where if you're logged in, you can just press go, and it will get an email to that address that we just showed, and someone will call you back. If you've been working with Chris, we'll know that, and he'll be the one that calls you, potentially not us.
Was the dinosaur your idea? I mean, I like
that. That's a Google thing, right?
Google
you can
thing,
easily create QR codes for no cost on Google. They just come with the dinosaur.
I love the dinosaur.
Yeah.
Comes for free. And once again, transparency is such an important component of the fund. It's definitely what drew me to the fund, and obviously my relationship with Pat. Jump on this website, dig in as much as possible, do your own auditing if you want to. It's incredible.
Yeah, this is that specific site that I referenced throughout, where the financials are posted, where the operating history is posted.
All of the loans
Absolutely.
that you can dig into.
So again, just right from the home page, hover over Invest and click Investment Fund, or here's the direct URL.
Thank you guys so much for joining us and hanging with us despite technical difficulties. Pat, I think you timed this event without having a Dodgers game right now. So really savvy.
Yeah, but, I'm glad it was on their night off, right?
Yeah, exactly. You did a great job planning this. So thank you, everybody. I'm sure there's some questions in the chat. I'll get to them, and Pat obviously will review with us too.
Yeah, and again, folks, for those that are already investors with us and have been, thank you so much for your partnership. None of this works without the capital. And for those that are out there that are considering it, we'd absolutely love the opportunity to be of service.
Thanks, everyone.
Bye-bye.